The following is a presentation of TFNN. The Tom O'Brien Show is produced every business day. Tom takes your phone calls toll free at 1-877-927-6648. Internationally at 727-445-1044.
Let's go to Robert in New Jersey. Hey, Robert, what's going on?
Hey, Tom. A great show. I've listened to you for years. You got a great thing. I've been listening to you for over a decade. That's amazing. You've done a great job.
I appreciate it, man. Appreciate you growling and prowling out here with us.
Now, Tom O'Brien.
Hi, everybody. Basil Chapman sitting in for Tom O'Brien, the one and only Tom O'Brien. It's my pleasure to be here. Usually, I'm at 11 o'clock till noon Eastern Time with my Tiger Technicians Hour. That's the show that, same thing, call-in show, 877-927-6648. My pleasure to be here every market day, Monday through Friday at that time, and love to take your calls. So we'll do the same thing here. And what's even more important, Tom, at this moment is at the World's Money Show. I believe that's in Orlando. So Tom will be back soon, and let's look at the market because we're looking at a very interesting phenomenon. With all that's going on, this market has been resolute in trying to find support in holding, and I'm talking about, just for the moment, I'm talking about the Dow. Let me go to this chart right here. This is the Dow chart that I show my subscribers to my opening call every single day. And what we look at is, let me show you, I give a little report, there's a little paragraph underneath, and then I make a copy of this, and within this context, I still add another paragraph. That's the first chart that goes out every morning in my opening call. And what I do with that is I show within the framework of the Chapman wave methodology. Let me just go to this very quickly. Let me show you the basic concept because it is so simple. There it is. Let me just grab it right there and slide it across. When you're looking at this particular chart, what you will see is from the lowest, most obvious lowest bar, that's really the way I look at it, the little V-shaped bottom, start counting each successively higher peak and grade it with uppercase letters, capital A, uppercase B, uppercase C, uppercase T. The objective is to take you from this low bar to at least 4 higher peaks. The concept is so simple, and it occurs in so many time frames. It's like it's a fractal. It is just a little design that repeats in whatever time frame, whatever chart you're looking at, you'll find them. Of course, that's technically. Emotionally, sometimes it's very difficult to do. Look, you've had the Greek debacle thrown at us. You've had the dollar screaming high. You've had gold moving high with the dollar. You've had bonds. You've had yields at all-time record lows. And we've had to be stalwart in looking at the upside up until now. So this is what I'm looking at. You've got the Dow having held the 17,000 level all the way through there, 17,067 on the 16th of December. You get to the 16th of January, it goes to 17,243, just a little underneath. Then it goes to 17,136, still a little bit 100 points below on the 29th of January. And then on the 2nd of February, what does it do? It goes to 17,034. And you see that gray-blue line right there? That's the 200-period exponential moving average, and it holds. Not only does it hold, it gives you the same ricochet, trampoline bounce that you've seen so many other times. Now the question is it one of these from the October 15th low where you took that massive move to the upside? Is it one of these where you only went a single leg up to the all-time high of 18,103 from the 16th of December? So far, it's not these two failures that went very strongly higher for a couple of bars, beautiful candles, and then plop, gave it all back. So far, this is matching both that one, that very strong leg that went to an all-time high, and that one. We'll get more into this a little later on. Let me just give you the numbers. The Dow is up 165 at 17,838. The S&P is up at 2,058. It's up 16. The comp index is up 37 at 4753. You've got gold, and this is really interesting. Gold is unchanged, and gold is holding very well. I'll just show you the chart. Now, I'm going to go to all these charts, but right now, let me just do this. And what we're looking at here are 4 time frames. You've got the daily, the weekly, the monthly right there, and you've got the 120-minute chart. And it shows that gold has had a fabulous move up from the mid-1100s all the way to 1300s, and it's pulled back. And it's trying to test the 200-period moving average of 1253. It's right now 1266. And the weekly chart is technically very good. But the daily is saying, hey, that was a tremendous move. I just need some time. And in fact, it could even pull back towards the 1240s. The 1246 level is this black line, the 9-period exponential moving average support. And the monthly chart, well, I don't want to talk about the monthly chart because it's still very negative, but it says it could be a bounce that lasts a little bit longer, maybe another month or two even, in the gold, as long as 1220 holds on the gold on any major pullback. So now let's go to bonds. You've got U.S. So bonds at this particular stage have had a fantastic move. They've had a move that has gone in. You remember I was talking about leg Ds in the Chapman Wave methodology? You can go higher, but D is really the objective. Well, in this case, the monthly chart has gone to an E within a major up channel. This up channel has lasted for decades, and you can now expect some kind of a pullback, but you've still got the Fed very much wanting to have lower rates. They're a little nervous about this, so you can see that it's held quite well considering that the market is almost at all-time highs. And you've got a leg F, maybe it's an alternate count, but in the meantime, what it's saying is that bonds have a trading range, and probably at 148, 149 right now, the high that was made over at about 151 to 152, that should be the high for a little while, and the big test will come if it tests the low of the 22nd of January at 149. So between 149 and 148, and the TLT, it's actually a little simpler because the TLT is the iShares Lehman Treasury Bond Trust, and that's gone to a leg D. It's probably going to be a peak D this month. We don't know yet. Leg E may be a peak E this week, and what's important about it, it's gone to a very unusual F formation in the daily, and that says, hey, be careful, because the body down at 132.28, about a point lower, that's going to be, I said to subscribers in my opening call, Traders Corner, where every day I update what we're buying, what we're shorting, whatever we're doing, and there I said 133 to 132 is kind of the area of support that we need to watch real closely for bonds. And if you want to look at yields, just look at the yield. The yield in the 30-year T-bond yield is at record lows. It was at record lows. It's still at record lows, but it's bouncing somewhat. And the 10 and the 5-year over here, that's the 10 and that's the 5-year yield. They've been in this area many times before. So it's really the 30-year that we're watching closely. So now I want you to do something. I want you to show you the IWM. The IWM is the Russell 2000. It's in leg D. Still very strong in the daily with the U-shaped formation. And it suggests in the weekly that it wants to go above 121.41 to start leg D in the weekly chart, and that would be leg D in the monthly as well. And then we've got to be somewhat careful. So that's that. I was asked a question. I'll get to it a little later. And now let's go to the dollar. DXY. The dollar at this particular point, of course, the market's not closed, so these are all active charts, has made a peak E with the same kind of consolidation, a little less than the TLT, the Lehman 20-year T-bond fund trust, and this says that the dollar at 93.57, down 41 cents, has a trading range right now. It's going to be a little tough to break to a new high above 95.48 just right now. Needs maybe a little more time. But my suspicion is that the low that was made at 93.25 on the 3rd of February, my thinking is that this is the candle right here, the candle of the 22nd with a low of 92.48 to the candle before of 92.15. I think we're going to be testing the 92s, which means that the euro could have a little bit of a bounce. And I'm calling it a bounce for now, but a bounce nevertheless. And if the euro is able to get to the 1.53 level, it's at 1.147 at this moment. Not only does the start leg C at 1.15331, but it says I'm now ready to maybe test 1.172, the 9-period exponential moving average of the weekly chart. But that says don't drop below 1.126, because if you do that, you're making that H pattern not a good pattern. So I was asked in the den if I would look at the IBB. Yes, the IBB is acting quite well on the day. It is the iShares NASDAQ Biotechnology ETF. We'll talk about that more, and we've got a break coming up right now. Basil Chapman sitting in for Tom O'Brien. I'll be right back after these messages.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
In quiet markets, investors search for new trading opportunities. We'd like to introduce you to a new product that provides opportunities even in flat markets. Nadex, the North American Derivatives Exchange, is a new and innovative Chicago-based exchange registered with the Commodity Futures Trading Commission, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their trading platform. Nadex never charges a fee to use their platform, which even includes real-time charts and full customization capability. Nadex's unique short-term binary options allow traders and investors to capitalize on strategies even when the underlying markets are quiet. Nadex's innovation has allowed them to come up with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com, or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foresight Fund Services, LLC.
Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks. We're back. Basil Chapman sitting in for Tom O'Brien. Dow's up 175. S&P's up 17. And right now we're going to go to Andy Hecht, the host of the Commodities Hour. And what a font of knowledge when it comes to the commodities and the different time frames in which to trade them, the different seasonal effects. Andy, how are you?
Hey, Basil, how you doing? Nice to speak to you.
Nice to speak with you. So,
are you up in Boston? Is it cold there today?
Oh, it is a real bit. I went out for a quick break to go and play tennis, indoor tennis, but walking along, it's over at Boston College, walking past the stadium, it was freezing.
I don't some days in the Northeast, I'll tell you.
We'll survive.
I know you will. Spring is on the way.
They say so.
Just a short couple of months away. So, what do you want to look at today? I mean,
I want to do two things. Number one, I want you please get your show is coming up in the next hour. You also have a newsletter. Could you just briefly give us a synopsis of what you do and what you look at in your show and what you do in your newsletter, please?
Sure. In the show, what I do is I go through the 6 major commodity sectors. I look at precious metals, I look at base metals, grains, soft commodities, animal proteins, which are the meats, and the energy. And I look at the technicals and the with a heavy reliance on really fundamentals. I'm much more fundamentally orientated than technically orientated. But I do look at the futures markets in each and what the spreads are telling us, what intra-commodity spreads are telling us, what inter-commodity spreads are telling us. So that's what I do on the show each week. And I go through each of the sectors and what's going on. And then in the newsletter, is, although I look at commodities only, I make suggestions and recommendations in commodity-related stocks and ETFs, ETNs, and options. But I do also give a full synopsis on a week-to-week basis of what's going on in the futures market and what to look for and, what my particular directional bias is and so on and so forth.
Great. I have a question for you. I'm looking at some of these charts. I see corn and wheat, just like crude oil, have just had a pretty spectacular percentage bounce right in the last day or two. But is there a particular commodity right at this moment that kind of piques your interest that you think, because commodities have been in a real bear market, but right now, what are you thinking?
Absolutely. Well, first, let me start with your comment on grains. Good observation. We have had some really nice bounces in the grains, and but albeit these grains are bouncing from very low levels. I mean, they're the lowest in many years. We had big harvests last year. Now, what we're seeing is there's a lot of shorts, particularly in corn and soybeans here. And what we're seeing here is we're seeing a squaring up ahead of a big monthly report that comes out this Tuesday, which is the World Agricultural Supply and Demand Estimates Report, which the USDA puts out, and it'll be released on February 10th at noon. So positions are being squared up. So that's why you're seeing kind of a little bit of buying there, taking soybeans back to around the $10 level, the level it broke down from, corn back to around the $4 level. Now, wheat's a different one, Basil, because wheat is a commodity that I like here because of all the problems in the Ukraine and Russia. Ukraine and Russia are big wheat producers, and it is possible with the problems in Russia that Putin will ban exports of wheat at some point, or that the fighting will escalate and they won't be able to plant or harvest as much wheat. So that's the interesting one in grains. My eyes are really focused on where everyone else's are, and that's the oil market here. Okay. I mean, we had a big down day yesterday. We had a big up day Tuesday and a big up day today, and it seems like oil is bouncing around here and looking for kind of a bottom. I don't think we found the bottom for a number of reasons. Number one, I'm seeing a widening in the differentials between Brent crude and West Texas Intermediate. That went down to flat a few weeks ago. Now we're at a $6 premium for Brent. And that's telling me two things. One, the world's a little nervous about the Middle East, which it's always nervous about the Middle East. But more importantly, the inventories of crude here in the U.S. are building and are at record highs, and they continue to build. So that's depressing WTI. That's more supply. That's not that positive. Also, the spread between March 2015 and 2016, which is an intra-commodity spread, a time spread, or a calendar spread, has gone out to around 20.6% for a year. That's enormous. That's an enormous contango.
Historically, where does that put it historically? Is that very unusual?
Well, it is. It's really kind of as wide as it gets. Now, historically, it's hard to say. Look, as opposed to interest rates, where interest rates are currently now, it is historically at highs. But interest rates are very low now. Right. We've had contangos this big when interest rates were higher in years past, when interest rates were 4, 5, 6, 7% or higher. But now with interest rates, I mean, we're at 1-year interest rates. They're so low. So this contango is huge, and it's the big boys are taking crude, putting it in storage in tankers, and just basically. If you can take crude oil, physical crude oil, put it in storage or in a tanker, sell it forward, and the cost of the storage, insurance, and financing is less than 20.6% today, that's a trade that makes you money while you wait. And it's a free call on backwardation, because if the crude oil market does tighten up, and hey, that is possible with the crazy Middle East. One thing goes wrong there, the nearby, we could have a supply scare. So it's a free call on backwardation, and you make money while you wait. So it's a beautiful trade for those with a lot of capital.
So it sounds to me this is right up your alley, because it's one of the more sophisticated ways of looking at things. And other sophisticated meaning that you've got to have a lot of experience to be able to understand what you do. And it also tells me that when you're looking at it, there is a specific way of trading that you would completely avoid, which is probably even more important than what you would actually do. And when I'm looking at the crude oil chart, the continuous contract, from the high of July of 2008 down to the low of 2009, there's been an H pattern, lowercase h, that turns into a lowercase m pattern, and then it broke down. I'm just a little concerned that it has what I call a propeller shaft look to it, that there could be an equal decline to the downside as there was from the upside to this middle area, which says that if not now, but in the next 3 to 6 or 7 weeks, if crude oil doesn't have a big rally, but instead it takes out the most recent low, that would not be very good. And of course, we're always.
I agree on a technical basis, but oil is much more than technicals or fundamentals.
Absolutely,
oil
because it's political.
It's so political. So it's you got to kind of throw that into the investment calculus there. What I'm looking at, Basil, here is gasoline. I think that gasoline is going to tell us where crude oil is going. And I kind of like the action in gasoline. We're coming into driving season. As cold as it is there in Boston today, 2 months from now, the snow is going to be melting. We're going to be in springtime. People are going to get in their cars and drive a lot more. And then the summer comes.
They get into their bigger cars. Because that's
right. They're gas guzzlers. Exactly.
Right.
Exactly.
In fact, I have a whole thing coming up. I'm going to talk about it in a little while. It's up on the front page of TFNN. It's 1929, and today. What's the match? What are the comparisons? And automobile size and engine size is part of what I'll be discussing in the webinar I'm giving 2 weeks from today.
You know what's cool? Taking something that's good for you. Something specifically formulated to help with weight loss, better sleep, stress reduction, and the need to detox.
Nico, our hunter and gatherer ancestors found all their nutritional requirements for health in their wild environment. But today, our food sources no longer contain the vitamins, minerals, and nutrients our bodies need to stay healthy and strong.
That's why we need Primal Edge Daily Nutrition. It includes a special blend of ionic, soil-based vitamins, minerals, fatty, and amino acids in an easy-to-use liquid form.
Primal Edge is powered by highly concentrated fulvic and humic acids, nature's preferred delivery system. They have been called miracle molecules because, like sunlight, air, and water, life cannot exist without them.
That's right, Paige. They ensure we receive all the nutrition we need to be healthy and thrive. We take it every morning.
Primal Edge, formulated and approved by Nico and Paige of Living a Primal Lifestyle. Buy it today for just $89. Click on the Primal Edge banner on the front page of TFNN.com.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Technomental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how Everbank can help keep your money thriving just the way you want. Is growing your money a priority? Everbank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? Everbank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. Everbank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you like it does me, visit everbank.com/TFNN to find out what they can do for you. Again, that's everbank.com/TFNN. Visit them today. Everbank is a member FDIC and equal housing lender.
Tiger Real Estate Opportunity Fund is currently offering 4-year first mortgages on many of the fully renovated properties that it has purchased. The first mortgages are third-party appraised with a maximum loan-to-value ratio of 70%, providing a secured investment that pays a fixed return of 5% annually, which works out to a monthly income of more than $416 per $100,000 investment with your principal intact and secured. These 4-year first mortgages are perfect for anyone looking for a secured investment that provides monthly income much like a CD. For more information, email tigerfund@tfnn.com or click on the Tiger Real Estate Opportunity Fund banner along the right side of the tfnn.com homepage, or call our office directly at 877-518-9190. There's a limited supply, so act now.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
Hi, folks. We're back. We're back, and the Dow's up 202 points, getting closer and closer to that 18,104 for leg D in the weekly chart of the Dow. The S&P's up 20, and we're on. I hope we're still on with Andy. Andy, I'm sorry we went right through the break there.
That's okay. I'm still with you. I'm still with you.
Good,
I wanted to talk to you about the dollar for a minute.
Okay, sure.
If we could. Like I said at the beginning of my segment, I'm very, very much a fundamentalist, and I believe that this dollar here, this correction, any dip in the dollar here for fundamental reasons is a buy. And I think that that's going to continue to pressure many commodities. But what's very interesting to me is how the dollar and gold, which generally have an inverse correlation to one another, have a positive correlation in 2015. And I think that's telling us, Basil, that flight to quality in tumultuous times means that money is going to come to the reserve currency of the world, the dollar, and gold, the oldest currency in the world.
I've always called gold the currency of fear. But what's very important about it is that I think for a while, gold has been on its own trajectory in the sense, and that's why for my subscribers, we actually have an ETF on gold, because I think that I do call it a counter trend rally, but you can tell that gold did not move the last 3 days, even with all the Greek chaos going on. And we're going to watch it real closely. But it seems to be saying that things will smooth out over there, at least in the shorter term. And so it's interesting. Don't you find it interesting that both gold, the dollar, and bonds are pulling back, and they were going up together? It's very interesting.
I find it interesting. I mean, and I also find it interesting that there's big divergence within the precious metal sector. You have platinum trading under gold, $10 discount to gold. That is not the normal state. Platinum is a 10 times rarer metal than gold. You have silver, which closed the year at 71-1 on the silver-gold ratio. That's the number of ounces of silver value in each ounce of gold value, is now at 73+1, which means one of two things to me, Basil. Either silver and platinum are too cheap here, or gold is too expensive on a historical basis. But I agree.
Interesting.
Gold is on its own trajectory here, and I see the positive correlation with the dollar. On days that the dollar is down, gold tends to be, soft. On days that the dollar's up, gold's been rallying. It's very interesting.
So for anyone who's interested in your newsletter, they should what? Go to the front page of TFNN and...
Yes, and just, click on it. You get a free 30-day trial to check out the Technomental Commodity Report. And another thing, on February 25th, I'm going to be hosting a webinar on crude oil, what energy technomentals are telling us. And if you sign up, you get a free report. I updated my report on crude oil, what to look for in the crude oil market, because the nominal price of crude oil means nothing. There's so many other factors that go into crude oil and understanding that market. And I have a report out. So it's a free webinar. If they come to sign up for the webinar on the front page of TFNN.com, they'll get my report and they'll get the webinar 1 hour with me on February 25th, which is
I
Wednesday
highly
from
recommend
5
it.
to 6.
Andy is an absolute, he's a font of knowledge when it comes to all the commodities and especially crude oil. Hey, Andy, thank you so much for giving us that information, and definitely, I hope people sign up for it.
Great. I'll be on at 5 today.
And don't forget, folks, Andy's coming up at 5 o'clock today, straight after the Tom O'Brien Show. It's a terrific show, of course. And thank you, Andy. Have a wonderful day.
Thanks, Basil. You too. See you soon.
Thank you. Folks, we're going to go right to Gary in California. Gary, how are you? Gary wanted to look at Apple. Gary, if you're there, just charge right in and say, I'm here. Now, I'm not sure. Oh, he's gone. I'm sorry about that. Apple, you want to know about Apple. Folks, you remember just a moment ago I was telling you about the Chapman Wave methodology. Let me just drag this chart right over here. You remember what I said? From the lowest, most identifiable low bar, all you have to do is count each successively higher peak, peak A, B, C, D. D is where something else doesn't have to, but that's where things can happen. Other things could recycle higher, or you could take a very strong decline to the downside. And look at this. Apple is in leg D. But the MACD, the moving average convergence divergence, is still very strong. The slow stochastic is very strong at 90%. The weekly chart has just made a Chapman Wave cup and ladle breakout pattern, which invariably goes to a D. Well, this is a leg D, but what I would say is because fund managers right at this particular moment have to choose the very best of the best, they're going to be choosing Apple. They're going to be choosing. Yesterday, I had a caller to my show. We were discussing Disney. This person owns Disney, and what I'd said was, Disney fund managers have no choice. They have to look at Disney as if to say, hey, I don't have this thing, and it's one of the best stocks around. And I said to him, it was at about 100.60 or something like that. I said, if it can pull back a little bit, you might want to keep your position as a core position and add something. Why? Because it's a really good chance that it's going to push even higher. And if this turns out to be leg A, you've got at least a week and a half before you can get to the fourth highest peak. So this is looking good. And look, today it's up another point in up at 36 at 102.65. And this particular move here says that if there is a digestive period for Apple, it could turn into a flag pattern between 105 or 106 maybe, and if it holds the low of 98.82, that was the gap up yesterday, the low of the gap. If it holds that until Monday to Tuesday of next week without breaking it, it says that there's a real good chance before it comes back to fill this gap. It will fill the gap in the 98 to 94 area at some point, but until it does that, it could have a higher high. So this is a very interesting stock. Now let's do something else. I wanted to mention, is this it? TFNN right there. On the front page of TFNN, it says, free newsletter and webinar by Basil Chapman. Get a free month of the opening call and get access to Basil's subscriber-only webinar on February the 19th, the 1929 market, then and now. Why is the timing? Why did I wait until I thought that the timing would be really good based on my Chapman Wave methodology? It's because at this particular moment, there are, for the very first time, it's been occurring over the past 2 months, I'd say, there are tremendous similarities between the 1928 and 1929 chart. Does it mean to say we're going to the Great Depression? No, it doesn't have to say that at all. It just says that there are so many coincident factors. Look at this. The 1929 market, then and now, and look what they've got here. They've got the glass bubble. Well, the glass bubble came out in the last year of that major move. In fact, there are stories of people who were out on their cruise ships, or they were going to Southampton in England from New York, and on the way, they would be checking out to see what the stock market was doing. When the stock market eventually crashed, they were getting news in these bubbles, and it was, for those of you who were involved in the 1987 crash, you'll remember that you couldn't get information for days. You didn't even know if you owned, what you didn't own. It was just terrible. Well, these people were getting information that was 2 to 3 days late, but that was the most modern medium. What do we have now? We have instantaneous things people can do within a split second. You cannot sell your house in a split second. You need to get it ready. You need an inspection. You need to see that the deed. You got all these peripheral things before you can even put up the sign that says for sale. And then you need lawyers. And then you need to pass. There's a whole. If you want to sell your IBM or your Apple shares, all you have to do is go click. It's not even a split second. It is click. There's a really big difference. And what we're looking at now is that within the context of similarities, there are so many things. I wonder if I can do this. Let me see if I can do it. It's going to be really interesting. I'm going to take a chance. If I can find it. Oh, I hope I can find. There it is. So, Chapman Wave subscriber webinar, the parallels with the 1920s, Thursday, February the 19th, 2015, 6:30 to 7:30 p.m. Look at this. Are we looking at chart patterns or socioeconomic parallels? Look at these cars, 1929. Look what we have facing right now. Look at the similarity. Look at the finish. Look at the two-tone finish there. That happens to be a Duesenberg. Look, that one there. Convertible Bentley. Look at this. The similarities are extreme. So are we looking at chart patterns or socioeconomic parallels? Both. There are technical signs that we are entering a price chart match linked to the Dow's 1928-1929 rise. I'll talk a little bit more about it. I'll be back. Basil Chapman sitting in for Tom O'Brien. Dow's up 203 points.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy. A set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 8 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Tom O'Brien.
Folks, we're back. Basil Chapman sitting in for Tom O'Brien. Apple, I just wanted to finish this. Apple's in leg D in the daily. It's in leg D in the weekly. And it's making a peak D in the 120-minute chart. So that says, hey, tomorrow there could be some kind of a pullback here, but it doesn't say the technicals are still very strong. Just says pullback, major support between 118 and 117 right now. As we're about to finish this break, let me do a couple of things, because when we get back, the market will have closed, and then we will get some earnings reports. So in the meantime, let me explain what I'm looking at. One of the reasons why, for my subscribers know that I've been impatiently bullish for quite a while now, expecting that somehow, some way, there would be a leg D up in the weekly chart, because it's so unusual to fail at a C at an all-time high, as the Dow would have done if it broke decisively under 17,000. So right now, we're only 150 or something, am I right? About 150 or maybe 160 points, 100, 200 points. No, yeah, 160 points away from the 18,103 all-time high. I think it's doable. The big thing will be, will this still be a leg A if it breaks to a new high, or will it pick up the old wave count? Well, this is going to be very interesting. But most importantly, the Dow diamonds are only in leg peak B, and that would make it a leg C at 180.71. The SPY, the S&P, is in, well, that was an aberration. That's a bad tick. I don't understand why it was never fixed. There was no trade there. I don't know what happened on that day. But this is peak A, that's peak B, and it says that the S&P above 208.97 goes to leg C. Here's my thinking. And it's been my thinking for a while, as long as that 17,000 held support. My thinking is that the Dow is going to go to a higher high. The S&P is going to join it. The S&P will get to a leg C. The Dow will be in leg D in the weekly chart. I want to wait for a leg D in the S&P. It doesn't have to be much higher, but I want to wait for that in the SP, SPX.X. And at that point, you get to leg C at 2,093.56 if it happens. It doesn't have to go all that much higher. There's a lot of resistance in that trend line, that up channel, what I call in the Chapman wave, the inside track resistance. Then we pull back. And in that pullback, you'll see something like the IBB, which is having a pretty good day, but I'm still looking at this and I'm saying, I think there's going to be an arch formation. It's made its major high on the 27th, the biotech iShares. They're going to fail very soon, and they're going to come down and break 305. When it happens is the big issue. So I'm looking at this, and I'm saying the rotation between the autos, the aluminum's doing well, Alcoa, MDY, the mid-cap, is breaking to all-time highs. So we'll see a rotation with distribution continuing in the biotech area and some of the really big winners, but new players are in the game. And that will take us to higher highs to that leg D in the Dow, and then C in the S&P, and then D later in February, slightly higher. Then we've got to be very careful. That's not the big top, though. That's a top, not the top. And that's why the timing of this webinar, 2 weeks from tonight, go to the front page, check it out. It's easy to join, to be able to become a subscriber. It'll be a trial for a month, but you'll be able to come to the webinar. And not only that, when I look at my Dow Quartet, GE, there's a Dow Quartet index, GE is coming on okay. It really looks terrible, but at least it's acting okay. IBM, out of all the technology stocks, is holding okay, but the weekly chart is really not good. But look at Triple M. Triple M is just about to make an all-time high. It's at 166.38. It needs 168.17 for an all-time high, leg D in the weekly chart. And UTX, which my subscribers are along from my newsletter, doing very well. It's at 120.05, and it suggests it should go to 120.96 for a leg D in the weekly chart. So we'll see. There could maybe there's going to be some bad news, but in the meantime, back at the ranch, and I'll go a little bit more into it in the next hour. The VIX index is under the 9-period moving average at 1830. That's the 9-period moving average. It's at 16.98, down 1.35, down 7%. But it is holding quite well, considering what's going on in the market. It's buyers have been there in the volatility index as insurance, I believe, at this particular point. So we're going to watch this really closely. Now, even more important than just the chart formations for me is how the weekly VIX index closes. If the VIX index closes under 17, somewhere in the 16 to 15 area on Friday, that's tomorrow afternoon, that'll be fantastic. I don't think so. I think that it's going to be sticking around here a little bit longer. There's a lot of nervousness. You can tell there's a lot of nervousness. But at the same time, buyers are stepping up to the plate on every decline. They've been doing that. And my suspicion is that we will somehow or other just manage to go slightly higher in February, based on my weekly charts of the Dow and the S&P. If the Dow, for any reason, just breaks the 17,300, 17,200 area, that is going to be very negative action. So at this particular point, it looks like that's a breakout from that trend line right there. If you're looking at my charts, this is the daily, this is the weekly, this is the monthly. I haven't even spoken about that. In the next hour, I'll get to the monthly, because we've got 43 months from the high to the low to the high from 2007 to May 2011. And from May 2011 to last month was exactly 43 months. So if we break to a new high, we've negated that 43-month match that says, whoa, be careful, because sometimes time is very important in cycles. And we want to break that cycle by going higher. So now, there are a couple of things that I want to look at as well, just as we're about to go to this break, and I'll be back for the next hour of the Tom O'Brien Show. And what we're doing is, as the Dow is closing out at 2005, I wanted to show you the New York Stock Exchange, NYA.X. There it is. This is a brand new leg B, and it has to break this declining trend line for it to show superior action in the daily chart of the New York Stock Exchange. And that has to be in the 10,940s. That's 60 points higher than where it is right now, 10,893. There might be a little bumping into some resistance over there. It's that weekly chart that is really just a sideways consolidation. How does it resolve this? Does it break out into the 11,100s? Or does it suddenly turn around, go back under the 10,700 9-period moving average in the weekly chart? We'll talk about that when we get back. We'll talk about a lot of things. But thanks for being here, everybody. Check out my opening calls, my daily service, right there on the front page of TFNN. Don't forget, 2 weeks from tonight will be the webinar on the match of the 1929 period and where we are now. I'll be back in the next hour.
The following is a presentation of TFNN. The Tom O'Brien Show is produced every business day. Tom takes your phone calls toll free at 1-877-927-6648. Internationally at 727-445-1044.
Let's go to Sam in Irvine, California. Hey, Sam, what's going on?
Hi, Tom. How are you?
Doing great. You having a good day out there?
I am having a great day. Thank you very much. I want to preface by saying that I'm so grateful to you and TFNN for you to assemble such a great people, such a team to help the small investors like myself.
Well, we appreciate you growling and prowling out here with us, Sam. Thank you so much.
Now, Tom O'Brien.
Hi, everyone. Basil Chapman sitting in for Tom O'Brien. Tom is at the World Money Show, and it's my pleasure to be here. And I usually have the 11 o'clock till noon, Monday through Friday, market days, the Tiger Technicians Hour. Same call-in number, 877-927-6648. Same format. And you just call in and we'll go through whatever it is you would like to look at. And I just wanted to tell you that the Dow right at this moment, having closed, is up 211 at 17,884. I have the charts right here. This is what I show during my show, and I show my subscribers to my opening call every day. I show all these different patterns. And here you've got the daily in a brand new leg leg A. That is a single leg that went from this yellow line, the 200-period exponential moving average at 17,037 on the 2nd of February. Huge move up. It's done that many times before and then failed, gone to lower lows. This is trough D in the Chapman wave. This is the test. The weekly chart, let me just expand that I was talking about in the previous hour. Will the Dow break 18,103 to start leg D? What is leg D? Let me just quickly do this so that those of you who are new to my work, simply put, you find the lowest, most obvious low bar, and you merely count each successively higher peak, and it should go 4 peaks higher to a leg D and then a peak D. And under those circumstances, it sounds simple. Sometimes it's very difficult to actually have the patience to do that, but that's the concept, and that's the basic requisite, is to have a buy signal that goes to a buy mode going to a D. Well, the weekly chart needs a leg D. It's very seldom to go to all-time highs and fail at a C in a weekly chart or a monthly. So I'm expecting that somehow, some way, the Dow goes to 18,104. That's number one. The support now on the Dow is at 17,624 to 17,570 on the shorter term. Okay. Now the S&P, SPX. .X, the S&P was up 21 points at 2,062. It too has got a leg A, but it didn't quite break. It did it 2,064, 62, 2,063. Yes, no, it didn't. It needs to break it by about a point to start another leg up here. That'll be the real A. But here in the weekly chart, look how it's held beautifully, this up channel support, and it says there's a chance that if 2,039 support on the S&P doesn't break in the next week and a half, that if it continues higher, it will get to 2,093.56 to start a leg C. The implication is there will still be a pullback at some point in February and then a slightly higher high to start that leg D. That's my anticipation. So I won't talk about the monthlies other than to say at this particular point, the Dow and the S&P, the month hasn't finished, but at this point, both the monthly charts look fabulous. Now, I just wanted to do something else. I wanted to show the MDY, which is the mid-caps. Mid-caps might have started a brand new leg A, but what's very important is the leg C in the weekly chart. Now, I've got an alternate count in the monthly, but it doesn't matter what the alternate count is. The 9-period moving average of 259 is support, and it's at 269 right now. And everything about the chart at this particular, tomorrow it could change, but right now it looks very positive on the monthly, the weekly, and the daily chart. But we'll see what happens between tomorrow's close for the weekly chart and Tuesday. By about Tuesday, we'll know whether or not there's a chance that we will go to all-time highs. This is at all-time highs. The mid-cap, S&P mid-cap depository receipts. Now, let's look at the QQQ series. QQQ series needs at 103.76, up 80 cents. Needs to break that downtrend line, which the Dow Diamonds and the Dow did very decisively today. Needs to get to around about 104.30. and it's at 103.69 right now. So just as we're about to go to some other things, Twitter came out. Twitter is trading up 1.28 at 42. So it came out with, I think, a relatively a pleasant surprise there. What's important about it, remember I spoke about those Ds? Well, it's peak D in the 120-minute chart, and it needs to break above 42.47. That's a print. That's not overnight. It needs to do it during the day trading hours, and then it's recycled higher. And what's really important is that we had LinkedIn come out, and LinkedIn had a very good response. Now it's up 18. That's amazing. The high was 257.56 at peak D in the monthly chart, and look at this, 251 right now. It's 6 points away from its all-time high. And that's going to be very important because it continues the daily legacy. Oh, it's an overlapping wave. Oh, this is going to be very interesting. So LinkedIn makes it very positive. Now, the Qs should be rallying right now from the close. The close is 103.76. All right, well, maybe it's a little delayed. We'll see what happens there. So now I want you to go to gold. Gold had closed. Let me just check that out. Gold is up 1 at 12.66. It's just in a little trading range now after having a spectacular move. So the continuous gold has 12.53 is very strong support, and 12.47 is the support in the weekly chart, trading right now at 12.67. Taking a little bit of a breather. My suspicion is that it will go to leg D in the weekly chart above 1309 at some point in February. The monthly chart is not that great, but we're doing one thing at a time here. And let's go. So silver closed down 11 cents at 17.28. Platinum was up 12 at 12.53. Copper's been the real laggard over here. But what did it do today? It actually bounced a little bit. That's a good sign. So we need copper to bounce, but it hasn't been acting very well. And you've got crude oil, CL. Crude oil right now is up. It's up 239 at 50.84. It's in a little trading range. And until crude oil can really get to the 56s, we're going to see what happens. It could happen the next day or two, but it better not break under 46, because if it does, that's just not going to be good action. The dollar DXY, dollar is at 93.53. Also consolidating is fascinating. Dollar, gold, and bonds. The TLT, the Lehman 20-year T-bond fund, made a peak F in the Chapman wave. It's pulling back, and it's at 133.32. 133 to 132 is really the support that it needs to hold. If it doesn't do that, then 130.90 is the 9-period moving average in the weekly chart. And you can understand that after such a spectacular move, all of the gold, the dollar, and bonds just need a little bit of a breather, and I think that's what they're getting here. And I would like to say that that's... Okay, let's go to Jennifer in Wellesley, Mass. Jennifer, how are you?
Good, Basil. How are you?
Surviving this freezing, huh?
It's a lot of snow.
It's a lot of snow. You'd like to look at?
I'd like to look at Visa. I was in it and I took some profits, but I see it keeps going up. I wondered what you thought, what leg it was in. They're going to be splitting 4-for-1 next week.
Oh, that's right. Okay, so Visa trading right now at 271.80, up 6.91, and this is a very interesting chart because. So you said you took some profits, meaning you got out of the position, or you took some off and you've got some left?
I got totally out of the position.
So you're out of the position. Okay. So the way I'm looking at this right now, I believe this is new leg B to the upside, and there's a chance that in the pattern I'm looking at, there could be what I call a Chapman wave squash formation between the stochastic and the MACD. And what's really important, if that's the case, what happens is from the low bar, in this case the low of 245.17, there's a tremendous pressure that builds up based on this particular pattern, and it takes the price very quickly to leg A, then to leg B, and then to leg C. And at that point, it could pull back a little bit as the stochastic starts to pull back, but the MACD takes the momentum. So the stochastic's what I call the torque. If you have a car with gears, that's like going from first to second gear, and then it goes into the higher gears, and that's the momentum that's built up by the MACD, the moving average convergence divergence. I like the pattern right now. I'm going to suggest, so because you had a position and you've taken it off, I'm going to suggest that if you get another position, I would make it a little bit smaller Only because you've already been in and you've taken it out because you got a little bit cautious. So I don't want you to get too aggressive here, although I do see it going higher. And what's really important about it is that the ABC, I suggest that if it pulls back, if let's just say there's weakness tomorrow, there's a report that comes out, job, whatever it is, and it comes out, and for some reason you get a pullback, you got Apple at peak D, so you might have a bit of a pullback. So you pull back in Visa and it comes back to about the 267-ish area, somewhere between 267 and 265, probably where you got out. That's where I would start another position. And on that position, I don't know if 4 points is too much for you, but I'd have about a 4-point stop on a $267, 265 long. And I would go for that leg C and the leg D because the weekly looks strong. So I like Visa.
Very much, Basil.
I hope that helps you, Jennifer. Good luck. Thanks for calling. Folks, Basil Chapman sitting in for Tom O'Brien. I'll be right back with Brent in Martinez, California.
Today, it's hard to tell if the economy is coming or going. Regardless, I want my money going in the direction I choose. If that's your stance as well, then you want to know how EverBank can help keep your money thriving just the way you want. Is growing your money a priority? EverBank is committed to a yield pledge promise to pay high yields on your checking, money market, and CD balances. Looking to diversify? EverBank ingeniously developed accessible ways to spread your money around the world into foreign currencies and even non-FDIC insured metals. And when it comes to your wealth, they bring a highly experienced and global perspective to help you manage it. EverBank's financial philosophy flies in the face of the status quo. They believe your money's performance should not be determined by today's economic circumstances, but by the drive to rise above them and create opportunities that favor your objectives. If that excites you, like it does me, call 1-855-750-4051 to find out what they can do for you. That's 1-855-750-4051. Call them today. EverBank is a member FDIC and equal housing lender.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock and option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Check out the new look of Tiger TV. Now you can see all hosts, charts, and computer screens live in high definition. Whether it's Tom O'Brien, John Logan, Steve Rhodes, Basil Chapman, David White, Larry Pezzamento, Andy Hecht, Thinkorswim, or Carol Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV. Now, crystal clear in high definition, 24 hours a day, 7 days a week. If you haven't seen the new look of Tiger TV, then visit TFNN.com. Trade with confidence and clarity while using the software that thousands of institutional traders rely on to make the best and most accurate decisions. Choose from 1,000 equities, currencies, and futures instruments utilizing the TAS architecture. As seen on Bloomberg terminals worldwide, the TAS Profile Scanner is a benchmark technical filtering system that thousands of traders rely on, and now you can too. For a limited time for TFNN subscribers only, we've reduced the price to just $97. That's over 75% off. John Logan hosted a special subscriber-only webinar in December, and you'll gain access to that archive as well, so you can learn exactly what the TAS Profile Scanner can do for you. Try this product out. No matter what you trade, the TAS Profile Scanner can help you make more informed trading decisions. There's no obligation to pay anything. Don't let this offer pass you by. Get your 30-day free trial to the TAS Profile Scanner today by signing up at TFNN.com. Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Tom takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
Hi, folks, we're back, and a couple of things going on. Twitter, 479 million versus 453 million estimate. Very good. And, Yelp adjusted 08 adjusted versus 07. So Twitter is up $1.20. So we want to go to Brent in Martinez, California. Hi, Brent. How are you?
I'm doing fantastic, Basil. How are you today?
I'm well, thank you.
I just wanted to start out by saying I'm really looking forward to this upcoming webinar. And I'm not sure I ever thanked you for the previous one that I got to partake in, the stochastic one that you did.
Oh, great. Yes. I love that one.
No, that's been huge. I used that a lot, and it's been just a great resource that you provided to us, and I really thank you for that.
Can I just take this moment just to tell folks, if you go to the front page of TFN, you'll see it says right there, free webinar, Basil Chapman, free newsletter and webinar by Basil Chapman. Get a free month of the opening call and get access to Basil's subscriber-only webinar on February the 19th. That's 2 weeks from tonight. The 1929 market, then and now, and it shows the ticker, the glass ticker that came out right towards the end of that whole 1928-29 period, and what's going on today. And I'm going to be talking about glass tickers. I'm going to be talking about automobiles. I'm going to be talking about skyscrapers. I'm going to be relating the coincidental factors and see if they match up and what we can expect. Timing-wise, it's just perfect. Thank you so much, Brent, for mentioning that. So you wanted to look at?
I'm going to leave it up to you. I have two stocks. I have others I'm long, but these two in particular that we haven't really talked about. And they have totally different charts, and just you pick which one you think would be best to talk about. Either Freeport McMoran, which is FCX,
right,
or SFL, which I kind of emailed you about, the shipping one.
So this is SFL, which is a Ship Finance International. I think this is appropriate right now to be looking at for a couple of reasons. One is there's been a very nice takeoff. It's trading SFL. So SFL is Ship Finance International Limited, trading at 1565, up 68 cents. And what's really important about this is that it unlike some of the other shippers that really crashed, it had done actually quite well. The monthly chart went from a low bar to peak ABCD. Remember, we spoke about D's just a moment ago. Then it pulls back quite sharply, and it goes from that low that was made back at 862 in December of 2011, having gone to that high of 1798 in May of 2013, pulls back quite sharply under the 9-period moving average. That's the black line over there, and goes back to the yellow line, which is the 200-period moving average, and goes to peak E and then pulls back sharply again. And this time it goes from a high of 1990 down to a low of 1295, trading now 3 points, about 3 points higher. What's important about this is that it's made a peak A and then a peak B in what I call a rectangle formation in the weekly chart. And that's saying that it should somehow, either with the MACD trying to turn up and the stochastic acting quite well with a positive divergence, it should attempt to get to the 1618 resistance, but 1669 is the 200-period exponential moving average weekly resistance. Now we're going to go to the shorter time frame, which is the daily. Now there's a cluster formation. If you remember what we discussed about in the stochastic, especially if you put it together with the MACD, look how the MACD from the low bar recently at 1212, that's December the 12th, at 1295, it starts a really sharp move and it spikes up to about 14 1517. That's peak A. Then it pulls back. And what it does, it makes a whole bunch of sub moves to the upside. And each one goes to an A and then a B and it collapses. An A and a B and it collapses. Now, if I put the whole thing together, when you've had this many, this goes under the category, I must make a note of it. This is called a restart. In the Chapman wave, it's very frustrating. It's not our fault. We just try to diagnose what it is and analyze it and assess it. But sometimes everything's perfect to start, but it doesn't get out of the way of this rectangle. I'm going to draw in the rectangle right here. It keeps on bumping into the resistance. But when it does that, it has this one-to-one pattern. I want to do something for 1 second because patterns are fractals of human nature. And if you remember, I was talking to Andy Heck just a little while, about an hour ago, and I showed him the same thing in crude oil, except it went to the downside. And I said, be careful. It could be a one-to-one to the downside with this like a propeller shaft midpoint. Now let me go back to your SFL to put into the context of chart patterns. And what it says is, if correct, that this is new leg B, there should be a one-to-one move. We're almost there, but it should take you to the 16 level, and then you should get to the top of this candle right here of the 8th of December, 1672. Well, that's slightly higher than the 1641 200 period moving average. So this is the area that I'd be looking at. This candle, the big candle, the ugly candle of the 8th of December, that's the one you want to look at. And what's really important is you want the stochastic to get over 80%. It's at 74% right now. And you want the MACD histogram, those little green lines there, to continue being positive. I like it. I think it's doing well. And the support is at $15.25 to $15. I don't think it's going to get there right now. I think it's going to try for the 1580s first. Hope that helps you, Brent.
Oh, as always, it does, Basil. You're a great help, and you do a good job of explaining very thoroughly what to look for. So I always appreciate it. Have a great day, and I'll talk to you soon.
Thank you very much, Brent. Always appreciate your calls. So, folks, let's look at something else. And let's look at NAT, which was one of the very best of the shippers. It went from the 6.95 low back in October all the way to 12.08 peak F in the daily, peak E in the weekly, and it's pulled back sharply. That said to me that a lot of the patterns that we're looking at, which repeat, means that you could be looking at the gold contract, you could be looking at the oil contract, you could be looking at the dollar. These patterns that repeat over and over are the patterns that you've got to be really careful with. So when I look at the that is Nordic American Tanker Shippers. Now it should be starting another move, and if this is a very serious move, then in February it should take out the 12 resistance, it should take out the 1248 resistance back in January of 2014, and it should make its way into the 13 and 14 area. So it was a leader. Now you're getting, you got DSX coming off the top at a very sharp move. It's consolidating. You got dries, which is dry ships. Nice move today, but I don't want to see what has happened like in USO, crude oil. These are the dry shippers, but I'm just saying chart patterns. I don't want to see a pop up and then a give back, as if to say, I couldn't, after such a smash to the downside, I couldn't even hold the gain. I want to see higher highs and higher lows. That, after all, is the measure of a bull phase. Even if it's a 2-minute chart, if it has higher highs and higher lows, that's very positive. On the downside, if it has lower highs and lower lows, like the weekly chart of the United States Oil Fund, that's not good. So you want to see the oil fund, which closed at 18.92. You want to see, or 19.03. You want to see it pushing higher and pushing above 20.29. You want to see SFL right there, SFL, Frank Leonard, take this leg B and then push higher. That would be a big positive. We'll talk about the markets. We'll talk about a number of things when we get back. Basil Chapman sitting in for Tom O'Brien. It's my pleasure to be here. And normally I'm at 11 o'clock till noon for the Tiger Technicians Hour every day.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFNN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
You take a hands-on approach to managing your investments, and whether you're bullish or bearish on U.S. Treasuries, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foreside Fund Services, LLC. Tiger Real Estate Opportunity Fund is currently offering 4-year first mortgages on many of the fully renovated properties that it has purchased. The first mortgages are third-party appraised with a maximum loan-to-value ratio of 70%, providing a secured investment that pays a fixed return of 5% annually, which works out to a monthly income of more than $416 per $100,000 investment with your principal intact and secured. These 4-year first mortgages are perfect for anyone looking for a secured investment that provides monthly income much like a CD. For more information, email tigerfund@tfnn.com or click on the Tiger Real Estate Opportunity Fund banner along the right side of the tfnn.com homepage, or call our office directly at 877-518-9190. There's a limited supply, so act now.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Hi, folks. Basil Chapman. So the CME Group SBPS beats 0.95 adjusted versus 0.93. It made its high at a peak at alternate count. F maybe A in the monthly chart. D in the weekly chart in December at how much was that? That was at 93.91. Pulled back quite sharply to 83, I think it was. Yep, 83.43. Bounced nicely to 90.80. Up $1.25 right now in A, B, C. This is leg C, so they're using the same technique. Nothing fancy here. This is an A. But, of course, earnings can change things. I mean, it's the perception of what happened, and it's the reaction. I don't care, in fact, overnight what happens in the print the next day. We've seen stocks up 30, 40 overnight, and the next morning, by the next morning, they are down sharply, and vice versa. So look at this. There's that pattern. You see the gap down, and it's trying to fill that gap. We're going to see this. It's got that U-shaped pattern. It's very interesting. So 90.4. Let's see what Twitter's doing right now. Twitter, Twitter is up 4 at 45. So this is going to be very interesting because you've now got a little bit of leadership in some of these earnings reports. Rather than the smash to the downside, Twitter is trying to bounce. Now, the 200-period moving average at 43, that's going to be that's strong resistance. If it gaps over that, this is the ugly candle that it's going to have to deal with, the one at 50.24 to 39.94 back in October, the week of October the 31st. This could be the first time that earnings allows fund managers to be a little bit more confident in a stock that came out, Twitter Inc. came out back in November of 2013, opened at 45.10, went down to 38.80, and then it spiraled up to 74.73 in December, and then it plunged down to 30, I think it was. Was that 30? 29.51 in May of 2014. So this is leg A. That 53 level in the 200-period moving average, it needs to clear that decisively and get above 56 to start leg B, and that'll be the first sign that Twitter is starting a monthly buy mode. At this point, it's just it's not looking good. No, I shouldn't say at this point. Today it's looking good because it's gapping up after hours, up 4.5. But I'm saying the chart formation that's up until now is not that great. So it needs a lot of work to repair. That was LinkedIn. Let's just go back to LinkedIn. LNKD trading at 253.50, up 21.47, 253. Remember, the old high was 257.76. So these V-shaped or cup-shaped formations, they can be very powerful. How it handles the previous high is going to be really important. Oh, I tell you, this is the most fascinating market we've had in quite some time. Now, why is an Alcoa, which we owned and got taken out for a tiny loss, 20 cents, and then 20 cents, and then 30 cents in the 15s, and now it's at 17.07. It can be so frustrating. I had written down here to look at a chart. I wonder if I've still got it in front of me. Oh, where did I put it? A stock that HDB, no. There was a stock that I was looking at, and I just wanted to show how difficult it can be sometimes to buy these things because they're either acting quite poorly, like Alcoa was acting very well, and then it went sideways, and I thought, oh, man, this is not – look at the gap down and after the earnings and all that. And then the technicals were still, just as Brent was speaking about the technicals a little while ago, look how the MACD and stochastic have been so good. Now Alcoa is breaking out. These are the heavy cyclicals. Ford, General Motors, we happen to own General Motors in our portfolio for the opening call. Let's go to Jay in Boston. Jay, how are you?
Hi, greetings, Basil. I've got a question for you. I wanted to see if you could take a look at WTI. It's a leverage product that follows
WTI, yes.
Yeah, DWTI follows the very volatile commodity, which is oil, and it's leveraged, so it can be maniacal when it wants to. I'm looking for an entry in there if I can.
Okay. So we're looking at DWTI. This is the VS 3 times inverse crude ETN. So this is the inverse crude ETN. So you are looking to short crude oil.
In essence, yes.
Now, if I go to the SCO, which I've done a lot of work on, it's an ETN that I actually wanted to grab at some point a month or so ago, and I just missed it, and I thought, okay, I won't put it into the opening call. We had it in, and we didn't get it, and I left. And this is one of those that just screamed to the upside, and it makes it. This is a typical thing where you don't know where. Apple, every time you bought Apple, although it looked like a top, it turned out, when you look at the monthly chart, just to be another way station on the way higher. So it's very difficult sometimes to get these stocks. I remember it was right here, and then it suddenly gapped up in December the 29th. That was the second time. And that's the ProShares Ultra Short Bloomberg Crude. So we missed it completely. Then it went to 110.94 and pulled back. Now, I think you have your eye on the prize, but I think it's a little early. Let me explain what I'm looking at, just chart-wise. The weekly chart says that the MACD is pulling back, but it hasn't crossed negative, and the stochastic's still at 81%. So in a way, that's positive, but the price, it's a weekly chart, so we're looking at a Friday close, so this is still not yet closed for the week. But the price is under the 9-period moving average after making a peak D. So it suggests that this is a peak D in the weekly chart, but it suggests from the MACD that there's still internal strength. So I'm kind of agreeing with you, but now I look at the daily, and the daily chart is very negative in that it's made this H pattern, like a lowercase h, and it suggests that unless crude oil, unless the you don't mind if I use the SCO, because that's kind of the root of, in a way, of what you're looking at, right?
Oh, sure, yeah. This is just SCO on steroids is all. Yeah.
Right, so we'll look at it without steroids for now. So what we're looking at, it's got a little peak A, I call it a gray A, because it's in a retracement bounce. Now, what's really fascinating about this, there was no other way I could count this, but it made a peak C minus in the 120-minute chart. That is really unusual, but it does that occasionally. And that's a very big negative, and it plunges down, and now it's giving it a little bounce. But I don't see the bounce. I see more if I go to the USO, which is really the root in the long position. I see that the magnet of the 200-period moving average of 19.48 in the United States Oil Fund LP is more an attractor, and it's gone to a peak C, which suggests that there's going to be another bounce either tomorrow or Monday that says it should go a little bit above the 20.29 high that was made. So I'm going to say to you, I think crude oil is going to come back down later. I think this is a very necessary relief rally because it's just been down for so long. I don't know if it's going to go that much higher, but it might use time rather than price. But coming off a bottom, I don't have to tell you that when something comes off a low that it's been in for ages and ages and ages, the percentage gain from 16.50 to 20 is like 4 points. That's huge. So percentage-wise, I think it'll be quite nice, but point-wise, I don't see the USO doing much of anything other than having a pretty nice bounce, maybe getting to the 21.5 to 22, maybe even 23 area over the next 2-3 weeks. Nice percentage, but nothing compared to the monthly and the weekly charts themselves. So I'm going to suggest have a little patience. I don't think you're talking about a trade for an hour and a half, right? You're talking about a position play like you had before. Am I correct?
I'll take what I could get. I would have loved to have gotten into WTI at 93. I missed that this week. This thing moves so quickly.
Very quickly.
Would have been lovely, and I would get out as need be. A leveraged product has its own inherent decay, and so I know not to marry the vehicle.
So here's my recommendation. Percentage-wise, I would rather be looking at the same percentage on the upside to play the bounce and then come back to the short side. I would put it by the 15th, 20th of February. I think maybe the rally is almost done. I'm not sure, but that's kind of my thinking. So right on a short-term basis, I think there's a greater chance of a pop up tomorrow in crude oil than a pullback. So I'm going to recommend this is not the vehicle right now. I'd rather be looking at the positive side.
Oh, good. Yeah. I'll hold my fire, and I will wait.
Okay. Thanks so much for calling, Jay. Let's hope we get up into the 40s and 50s, not in crude oil, but in the weather.
I'm with you.
Thank you.
All right, thanks. Bye now.
Let's go to Jim in Denver. Jim, how are you? Jim, are you there? I think that Jim might be on the computer, but Jim, just yell, "I'm here," as soon as you're here. All right, so then let's do this. Jim, you wanted to look at WLL. It's in leg D. I'll try to get you just now. Let's go to Mark in Denver. Mark, how are you?
Good, how are you?
Good, thank you.
Good. Are you going to break?
Yeah, but tell me what you'd like to look at.
It's called the Dow Jones U.S. Completion Total Stock Market Index. It's DWCPF.
Give me the symbol.
DWPCF.
CF or DF?
C is in Charlie.
CF.
Platinum, grains, crude oil, gold, copper, cattle, hogs, gasoline, natural gas, coffee, cotton, cocoa, and sugar. These are just some of the commodities mentioned in the most recent issue of Andy Hecht's Technomental Commodity Report. Andy publishes his weekly newsletter every Thursday morning, where he breaks down the commodity market and provides his subscribers with specific trading recommendations based on his trading methodology. By signing up for a free trial to the Technomental Commodity Report, you'll get a full 30 days to try out this powerful newsletter service and see for yourself the types of trades Andy has recommended for his subscribers. When you sign up for a 30-day free trial, you're under no obligation to pay anything. And should you decide to continue, you will lock in the low rate of only $79 a month. Sign up right now for the Technomental Commodity Report and make sure you're ready to catch the next big trade in commodities. For more information and to get started today, visit the front page of TFNN.com.
The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN, and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now. TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Each and every time that the dollar ticks higher, S&P wants higher price. Each and every time that the dollar's ticking lower, guess what? S&P wants lower price. Dollar, the metals, and the S&P are going tick for tick.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. Join Andy Hecht as he shows you how to make money in commodities. The Commodities Hour, next on TFNN.
Tom O'Brien.
Hi, folks. We're back. I love that Tom O'Brien. It sounds so, it's like the a cappella, and it's just the right intonation. Tom O'Brien sounds wonderful. Okay, so we're on with Mark. And Mark, I've tried every single symbol which way. I even went to my Filer trade station to find out which is the, this is, so give me the name of the index itself.
3 or 4 funds I can put my retirement money into that relate to stocks. It's a small cap stock fund, and it's called the Dow Jones U.S. Completion Total Stock Market Index.
Oh, completion. I didn't get the word completion. All right. I don't think I'm going to be able to have time to do it. You know what? Tomorrow morning I'll try to look at it. But in the meantime,
anyways, what I was going to tell you is it's broken out to a new high. And it's
because it's probably
weekly.
It's probably closer to the MDY, the mid cap, because it's a total return and it's not as affected with oil and the dollar. That's my thinking. Yep. So
I just wanted to let you know it's kind of interesting. It's in a weekly C and it's at a brand new all-time high.
So now this is what I'm going to say. So the question you have is, do you add? Do you subtract? What the question is?
No, I have about half of my account in there, half in the S&P and half in that, and I'm waiting for this to get to at least a peak D weekly before I pull it back into cash. And I just wanted to mention that it's in a C, and I wondered if there's, I just was wondering if you have any other analysis on it. So.
Yes, I have an analysis only in that I can't see it. I can only imagine that it's probably very much like the one that I'm showing right now, which is the S&P mid-cap deposit receipts. Why? Because it's so broad. It's not as specific as the Dow or the S&P 500 or the Qs, which are more high-tech. So I think that you've got a perfect mix, and that mix is demonstrating how broad this market move actually is. That's not to say we aren't going to have to get a little nervous come end of February or so. This is what I've been talking about since December, January, actually. So in the meantime, I'm with you. Stay in this. You must expect a pullback to make a peak C and then a leg D. That's where you can do other things. But in the meantime, stay there, and let's talk about this again as we move on in February. Hopefully, it doesn't take out the low that was made 4 days ago. Whatever it is that you have, the low that was made 4 days ago, watch out. If it closes under that, that's not a good sign. But so far, it looks, whatever you have, if it's based on the chart patterns that I'm looking at, so far, so good.
Okay, thank you.
Thank you for calling. So Jim in Denver wanted to look at WLL. In fact, we had a caller earlier who had WLL, spoke about it, and it's just on a tear. It's in leg D. This is the Whiting Petroleum something or other. And this is a nicer pattern because it made its peak A, and that's what I was speaking to the caller about when he called. And I said, I like the pattern. because it's different to the others. It had its big move off the low in the weekly chart back on the 19th of December. So we got to watch this closely. So it's acting very well. Leg D, it might pull back at 38.35. It could pull back to 36.35, but so far it's acting well. So folks, just before we wrap up, I want to do a couple of things. One is I wanted to just quickly talk about right here. If you go to the front page of TFNN, if you saw the charts that I had and what I've been discussing, I have a webinar. I have a chapter in a book called, it was a book called The Psychology of Investing. I'm chapter 11. And my chapter was called The Stock Market Hysteria Still to Come. And the opening paragraph is the mega bull market. Stock tickers at McDonald's, record high sculptured skyscrapers, 250 mile per hour luxurious grand touring cars, 4,000 passenger ocean cities to nowhere. As the supercharged Dow accelerates to ever increasing record highs, most of the socioeconomic parallels of the mid-1920s point to a mega move in the Dow just beginning to unfold. The seeds of a surge into the decade of the mega trends have already been sown. This was written in the 1980s. So we've been through many cycles before, but now we are looking at parallels with the 1920s that are awesomely similar. That doesn't mean to say we have to go into a big depression, but it does say, what would you be looking for in the world of skyscrapers? Just as the Empire State Building in 1929, the papers were signed in August of 1929. And, of course, we got the top in the Labor Day weekend at 386, and the market pulled back a little bit from 386 to 40. So you got to be careful. Empire State Building opened in the shortest amount of time. You can imagine how beautifully it was built because these are people that had lost everything, and that's the only job they had. They wanted to give everything to their job. It opened in the shortest amount of time. It was called the Empty State Building until 1951 or 1952 when it first made money. So all those people that say that you never lose money in the stock market over a given period of time, depends which given period of time, okay? So this is a perfect time to be looking at what is going right, what matches, why are the chart patterns right now matching so well the pattern of 1928 going to 1929? And what about, just in Boston alone, all of a sudden we're being called skyscraper city. They never had skyscrapers in Boston. And as long as I've been here, whenever we've had a building boom, it's never a good sign. And we're having a building boom right now. Will it end like all the others? I don't know. We've got a lot of factors that have been put into place. We'll see. But I want to talk about all the coincidental factors. Engine size. Look at this. I'll just go to this one more time. This is my PowerPoint presentation. Chapman Wave subscriber webinar, the parallels with the 1920s, Thursday, February the 19th, 2015, 6:30 to 7:30 p.m. Eastern Time. Go to the front page of TFNN to find out. Look, are we looking at chart patterns or socioeconomic parallels? Look at those cars of 1929. Look where we're getting to right here. So the answer is we're getting both. We're getting the technical signs that we're entering a price chart match link to the Dow's 1928-29 rise. And that was the latter, the period of recognition in the late 1920s leading to the top. And the popular song of the time in 1929 was titled, Happy Days Are Here Again. So I don't want to make it depressing. I just want to say, it's always good to know where you are. If you've got the train that's going from Boston to New York and you're having a little bit of brakes problems, you'd like to be able to get off at New Rochelle rather than waiting to get to the station and Penn Station. And that's really what we're looking at. So it's a look at the parallels. I'll be talking about the dissimilarities as well. I'll be talking about what could make it. Can the auto industry, which for the first time since the 1950s has got itself on the right track, we happen to be long, General Motors, Ford, Fiat, Fiat Chrysler, are we finally getting on the right track? I'll talk about that. 2 weeks' time. Don't forget, you can also listen to my show. I'll be going through some of this periodically before then. And that's my show and my newsletter. And go to the front page of TFNN and see how you can join my webinar coming up in